Interest rates are trending down. My inbox is full of solicitations from mortgage lenders for refinancing. Is now the time to look at a 15-year fixed? Good morning, good afternoon, good evening, depending on where you're at today, November 7th, Friday. Hope everyone is having a great week and excited for the weekend. Let's get started. We're going to talk about 15-year fixed mortgages here in just a second. If we look at today's interest rates, according to Mortgage News Daily, the national average on a 30-year fixed 6.29. That's pretty flat, maybe a little up, but very flat this week. 15-year fixed mortgages, 5.82%. Now you may be able to do better than that. We're going to use the national average to be fair to compare apples to apples today at 5.82 on a 15-year fixed. Government loans, FHA 6.02, that's right at our benchmark of 6%. We've dipped below that a couple times this last month, 6 weeks, down into 5.85, 5.9, somewhere in there. Jumbo loans, a loan amount over $818,000, 6.4 is the national average today. Okay, let's play with some refinancing options. In this scenario, let's say in July of 2023, we purchased a home for $495,000. We put 5% down and it got an interest rate of 6.82%. And now interest rates are down and we're taking a look at refinancing. If we were to look at refinancing into a 30-year fixed mortgage, this is what it would look like. Our current value is $600,000, up from our purchase price of $495,000. Our loan amount currently is $457,000, $469,000 would be our new loan amount. Here we go. Interest rate 6.875 when we purchased the home with 5% down. Today, according to Mortgage News Daily, the national average is 6.29. Our principal, interest, taxes, and insurance, our total payment drops down from $36.98 to $34.04, saving us $295 a month. So let's break down where that savings is coming from. If we look at a payment breakdown here, our principal and interest is going from $3,089 to $2,904 a month. And then we're removing that monthly mortgage insurance before we put 5% down. So we had monthly mortgage insurance at $110 a month. Since we now are in a better equity position of over 80% loan to value ratio or under 80% loan to value ratio, we can remove that mortgage insurance, saving that additional $110 a month. And that's where we get the total savings of $295 a month. Now, this may move the needle quite a bit for you, especially in today's economy with the increased price in groceries, cost of living going up, insurance going up. It seems like everything has gone up. It almost feels like a $100 bill is the new $20 bill, right? So saving almost $300 a month is a great scenario, and that will help a lot of people out. Now, let's say when we bought this house, I was the only one working in the family. We scraped everything together to buy the house. Since then, my income has gone up. I've received a pay increase at work. My wife's now working. Our income has greatly increased since we bought the house. And $295 a month, it would be nice, but it's not going to move the needle for me. Okay, so we're talking about a very specific homeowner. In fact, I might be fine with my payment increasing from where it is now if I can save money somewhere else. So let's look at what a 15-year fixed mortgage would look like. Now, I historically, in my 20-some years of doing mortgages, have not been a huge fan of 15-year fixed mortgages because, let's say, life changes. I have a business investment opportunity. I have to start paying for college. I want to spend my money somewhere else besides my mortgage. If I'm in a 15-year mortgage, then I would have to refinance into a 30 to lower my payment. But if I'm in a 30-year fixed mortgage and I've been making 15-year payments, all I have to do is stop making 15-year payments and make the 30-year payment. This week, I've started to see how this pencils out for a lot of people. okay? A specific set of people. So if we were to do a 15-year fixed mortgage, our interest rate would be 5.82. Now, I think you could do better than that. We've done better than that this week. If you want one of these analysis customized for you, reach out to me. I'd be more than happy to put one together and show you exactly where you would be as far as interest rate and payment and all that goes. Our payment would go from $36.98 up to $44.18, saving us nothing. Our payment increases, nothing up from a monthly payment, but our payment would increase $719 to $44.18. So if I'm comfortable with that, if a $720 increase in my payment is not going to affect my lifestyle at all, depending on what my goals are, this might start to make sense. So if we compare the 30-year fixed refinance to a 15-year fixed refinance, and we scroll down and we take a look at how much interest we're paying over the life of the loan, if my screen will cooperate here. We can see that in 15 years, our total interest paid on a 30-year fixed is $390,926 in the first 15 years. On a 15-year, our total interest paid is $235,000. So if we do some math and we figure out how much we're saving, we go from $390,926 paid in interest compared to $235,552. That's a savings of $155,000 over 15 years. So for a specific homeowner who's comfortable with the 15-year payment, with that $700 increase in your payment, and you have some goals that maybe you want your house paid off in 15 years, maybe you want to be in a really good equity position, and you can save $155,000, then the 15-year fixed mortgage might start to pencil out. And I think we can get that savings down even further by doing better than the national average on a 15-year fixed. Guys, I hope this was helpful. I hope it got you thinking. Maybe it got you thinking that I am not comfortable with a 15-year mortgage. I'd take the $300 a month savings. There's nothing wrong with that. Like, subscribe, reach out to me if you want to inquire about a refinance. Be more than happy to run a scenario for you. I hope this helps you out. We'll see you on tomorrow's live stream at 9 a.m. Pacific. Have a great Friday, everybody.